Hello everyone! Today we will be talking about the TILA-RESPA Integrated Disclosure or TRID rules, which are effective for RESPA applications dated October 3rd, 2015 and later. TRID is part of the CFPB's Know Before You Owe initiative. At the end of this video, there will be links provided for additional resources for TRID. What is TRID and Know Before You Owe? The intention of TRID is to provide greater clarity and simplicity to the borrower during the mortgage process by combining the TILA and RESPA documents. That is, the initial GFE and TIL have been combined and replaced with the loan estimate, and the final TIL and HUD-1 have been replaced with the closing disclosure. During this video, we will refer to the loan estimate as the LE and the closing disclosure as the CD. So, at a high level, what is changing with TRID? As mentioned, the initial TIL and GFE are replaced by the loan estimate, LE. The final TIL and HUD-1 are replaced by the closing disclosure, CD. TRID increases the timeline for closing due to additional delivery and review days. TRID decreases the ability for changed circumstances to reset fee tolerances. TRID reduces fee tolerances, which will increase lender-paid cures. The TRID rules are effective for all RESPA applications received on or after October 3rd, 2015. Any loans with RESPA applications before October 3rd will continue to use the RESPA 2010 rules. RESPA 2010 rules are those we have used with the GFE and TIL. There are a couple quick notes on applications. First, any loans with the GFE application prior to October 3rd must fund by December 31st, 2015. Also, any loans you are working with as TBDs will either be RESPA 2010 or TRID loans based on the application date. That is, if you have been working with a borrower since August and they find a property on October 10th, that will become a TRID loan. Lastly, TRID does not apply to reverse mortgages and HELOCs. These loan types will continue to use the RESPA 2010 GFE and TIL. The good news is every lender is subject to TRID, so there will be risks and opportunities. Those lenders and loan officers that embrace and are excellent with TRID will find new opportunities. Those that try to fight TRID will find a very rough road. TRID really requires two main things to be successful. Be proactive. Move the urgency typical at closing to the beginning of the loan process. Use pipeline management to make sure things are done in a timely manner and nothing is missed. Be accurate. All disclosures need to be as accurate as possible. This means taking a complete application, getting actual fee quotes. The ability to true up the fees at closing has largely been eliminated. This video is intended to walk through TRID in a process similar to the loan process. We will start with the TRID basics and then move from the pre-qualification to the LE, CD, and closing. At the end of the video, there will be a link of additional resources and information on the Amerifirst TRID Help Desk. This slide talks about terms and definitions. Many of these terms are carried over from RESPA 2010. However, there are a couple of new ones that you will want to know. We will not go over all the terms, but please take a few moments later to review. A couple of terms that matter. Be aware that the baseline represents the disclosed fees used for calculating tolerance cures. That the LE and CD have two versions, the standard version for purchase transactions and the alternative version for refinances. Know that the mailbox rule defines how and when disclosures are received by the borrowers and does not vary for disclosures mailed or sent electronically. The next slide highlights fee buckets and major changes from RESPA 2010 to TRID. Notice the fee bucket types: 0 tolerance, 10% tolerance, and variations permitted are terms used in the RESPA 2010. The biggest changes relating to fees are the appraisal fee is now zero tolerance. Upfront MIP has been moved to zero tolerance. Property taxes have been moved to zero tolerance. The no tolerance and 10% tolerance are largely determined by whether the borrower can shop for a fee. It is important to note that there are several TRID-related rules, like property taxes, being moved to a zero tolerance bucket that do not seem terribly logical. Illogical or not, the interpretations used in this video are the current requirements and AFI must conform. The industry and AFI are closely monitoring these issues and will update our policies as appropriate. This next slide addresses fee tolerances and setting expectations to loan parties. Remember the following. The initial LE sets the baseline for the life of the loan. The closing disclosure compares the initial LE fees to establish fee tolerances. Tolerance violation must be cured by a lender. Under limited circumstances, the 10% tolerance fees change with the valid change of circumstance. However, the baseline is not changed until the aggregate of those valid COC changes exceeds 10%. Baseline changes can only be made with an LE. Baseline fees cannot be increased with a CD, even with a valid change of circumstance. Once a CD is received by a borrower, the LE cannot be reissued. The takeaway. Make the initial LE and all subsequent disclosures as accurate as possible. Make sure to document every COC as permitted. This slide talks about sequencing during the loan information interview. Same as today, the aliens information is what triggers a RESPA allocation. The aliens are A is for address, L is for loan amount, I is for income, E is for estimated loan amount, N is the borrower's name, and S is the borrower's social security number. We cannot prevent the borrower from providing aliens, and we cannot require additional information to trigger application. Sequencing does permit loan officers to ask borrowers non-alien questions to determine the best course for prospect. Example, after obtaining the borrower's social security number and name, you then ask the borrower if they've had a bankruptcy in the last 18 months. If the answer to the bankruptcy is yes, about 11 months ago, then you may want to move forward with the borrower as a prospect and not ask the remaining alien questions. TRID, Borrower Prequalification, addresses a very useful tool when working with a prospect. In Encompass, as well as in Vantage, there are pre-qualification forms for both purchase and refinance. These forms are to be used prior to the LE disclosure and are a great tool to help show borrower various scenarios. It is important to note the CFPB has expressly prohibited the use of any other fee worksheets. Key points. Use of sequencing and the pre-qualification forms can be very useful for the borrower to consider various loan options when aliens information is not known. We cannot prevent borrower from providing aliens information. As soon as we have receipt of aliens, a RESPA application has been triggered and LE disclosures are due within 3 general business days. We cannot require additional information from borrower to submit the aliens information. Example, an online application cannot require, have you had bankruptcy in the last 2 years, to be answered in order to submit the aliens information. This slide topic is electronic consent. Electronic consent is required from a borrower before AFI can conduct business electronically with the borrower. The benefits of electronic consent allow Amerifirst and the borrower to send and receive documents electronically. Example, email and e-disclosures. Allow Amerifirst to rely on electronic delivery and avoid physical or snail mail. Ease and immediacy of borrower to document receipt of disclosures intent to proceed, etc. As noted later in slides 7.1 through 7.7, it is easy to see the benefit of electronic consent in expediting the closing timeline. As noted below, there are several methods and timings to obtain borrower electronic consent. The electronic consent request will be sent automatically at when email address is entered in Encompass, when credit is pulled, and during the appraisal process with AMC. In addition, the electronic consent request can also be sent manually from Encompass at any time. Note, once electronic consent is received from a borrower, no additional electronic consent request emails will be sent. Specific to manually sending the electronic consent, the visuals below show the electronic consent can be sent from either the e-signed consent not yet received alert or from the e-folder e-consent button. At the end of the day, the goal is to make sure that any borrower that wishes to conduct electronically is able to, and we document that consent. At this point in the loan process, we have triggered the LE application. The LE application is very similar to the current 2010 RESPA GFE process. Information to trigger the application is still aliens. We have 3 general business days to disclose, which excludes the application date, weekends, and holidays, same as today. The critical part of TRID related to the upfront disclosures is to understand the new forms and to be able to explain it to the borrower. Fee accuracy. The initial LE and every subsequent disclosure needs to be as accurate as possible. Be aware of the fee tolerance buckets. The ability to disclose and true up fees later has largely been eliminated. Be accurate. Related to the LE application and LE disclosure, there are some key takeaways. Remember, these are critical pieces of information that summarize hundreds of pages of TRID regulations. If you focus on these bullet points, you will know the critical information that will affect your loans. The timing to send the LE is the same as the current GFE TIL, i.e., LE must be sent on or before 3 days after the LE application date. AFI cannot require verifying documentation from the borrower prior to the LE being delivered to the borrower. You may ask the borrower and the borrower may volunteer, but cannot require. LE delivery method options. If all borrowers have agreed to electronic consent and the loan officer has not requested physical mail, the LEs will be sent via e-disclosure. If any borrower has not agreed to electronic consent or the loan officer has requested physical mail, the LE will be sent regular mail. Unless AFI has documentable proof of LE receipt, the LE is deemed to be received via the mailbox rule on the 4th day after mailing. Important! The mailbox rule applies to physical mail, e-disclosure, email, and fax. Semantics matter. Delivery is the act of providing to the borrower, email or physical mail. Receipt is the earlier of A, documented borrower's receipt, and B, the mailbox rule. Slide 3.7 continues with the LE application and LE disclosure. Rate locks, the initial LE, will function the same as current GFE and TIL. Once LE application is triggered, the loan may be rate locked and lock information included with the initial LE. As with the current GFE and TIL, the LE does not expire. Loan term and fee changes will be handled via the changed circumstance process. Again, this is consistent with how the GFE and TIL is currently handled. The earliest closing date cannot occur prior to 7 days after the LE is delivered to the borrower. Regardless of any other events or timelines, this is the bare minimum days to close. Once the CD, closing disclosure, is delivered to the borrower, the LE cannot be reissued. It is critical the lock date expiration covers the close of escrow and a reasonable period of time to complete the loan funding. As with the current RESPA 2010 GFE and TIL, the critical dates are captured and calculated in real time in Encompass in disclosure tracking. Just be aware of this and use as a reference for questions with disclosure events or timing. So what happens if the borrower does not use electronic process to document receipt of the LE? If the borrower is manually processing disclosure and you want to document receipt prior to the mailbox rule, the steps to document are: Step 1. Obtain LE forms signed by all borrowers. Countersigned is acceptable. Step 2. Upload signed disclosures to the e-folder in the TRID initial LE signed bucket. Step 3. Email disclosures@amerifirst.us. Step 4. Disclosures will review documents and complete the manual receipt. Step 5. LO, LOA, LP will be emailed when the LOS is updated. The expectation is that manual requests will be processed by disclosures as soon as possible, but within 1 business day. Clearly, the manual process is a lot of steps. Unfortunately, these are required to document the file for regulatory and investor requirements. Whenever possible, please talk with your borrowers about electronic consent and the benefits. Now that the LE is disclosed, we will move on to the appraisal order. This process is essentially unchanged from RESPA 2010 GFE and TIL. After LE is delivered to the borrower, the loan officer can process the appraisal order in the LOS in the same manner as today. If appraisal is borrower paid POC at appraisal order, the borrower will receive a link to accept or reject electronic consent if not already received by AFI, acknowledge receipt of LE, and document intent to proceed of current LE. If appraisal is lender paid or paid at closing, borrower will not receive the email link to the Arrive site. Although not a change from RESPA 2010, TRID emphasizes borrower cannot incur fees, and AFI cannot accept payment for fees. Example, appraisal prior to the documented LE consent to proceed. Note: some regulatory and investor interpretations are suggesting that obtaining the appraisal prior to intent to proceed makes the fee ineligible to be paid by borrower even at closing. AFI has not accepted this position. However, if this becomes widely adopted, then AFI will amend its policy accordingly. The post-LE disclosure rate lock is handled in the same manner as RESPA 2010 GFE and TIL. When the loan is rate locked, the lock will be processed with an LE change of circumstance. No fundamental change, same as today. The pricing-related loan fees will be set with the rate lock disclosure if handled on a LECOC, specifically discount and premium pricing lender credit in excess of previously disclosed LE lender credit. One thing to remember with pricing is how to handle points. Any points charged to the borrower are first allocated to the discount until par 100 is met. If you intend to charge points in excess of par, make sure to disclose origination points on the unlocked initial LE disclosure. Any points charged in excess of par are assigned to origination. If the loan has premium pricing or revenue in excess of 50 basis points, the amount in excess will be included as a lender credit. The intent to proceed has existed since RESPA 2010. However, TRID has greatly increased the importance of intent to proceed. There are a couple of key things to remember with intent to proceed. The borrower cannot express and AFI cannot accept intent to proceed until the borrower has received the LE. This is fairly intuitive. The borrower cannot intend to proceed with the LE terms until they have received the LE. Intent is expressed to a specific LE. If there is only one LE on the loan file, this is fairly straightforward. If there are multiple LEs on a loan file, then we need to identify and document which LE the borrower is expressing intent. In cases where there are multiple LEs and the intent is expressed for the non-current LE, Then we need to do a change of circumstance to update the LOS file to match the intended LE. For example, two LEs are issued on a loan file. First is the FHA loan type and the second is a conventional. If the borrower expressed intent on the first LE, which is FHA, then we need to do a COC to get the loan file from the current conventional information back to the FHA LE. Given this example of going from FHA to conventional back to FHA, it's easy to see why the pre-qualification process and loan scenario tools can be simpler and easier for the borrower. Note: each loan file requires only one intent to proceed and is only required from one borrower. We are not required to obtain intent for subsequent LEs once intent has been obtained. At this point, the question is, how do we obtain and document the borrower's intent to proceed? The easiest, most convenient method to capture intent is to send the borrower an intent email from Encompass that the borrower can review the LE critical loan terms and click a button to document consent. This can be done via computer or mobile device. Please note this intent method requires electronic consent. Again, when possible, please explain the benefits of electronic transactions and obtain electronic consent from each borrower. In the event the borrower does not use the electronic consent and documenting intent is manual, AFI is required by various regulatory and investor requirements to document the borrower's intent. This means that intent cannot be documented verbally. Approved methods to obtain intent are: borrower signs intent to proceed from e-disclosure and uploads to Loan Center. Borrower emails AFI, loan officer, with intent to proceed in email body and notes LE terms such as LE dated October 11th. Appraisal payment process with AMC with intent captured. When talking to the borrower and they express verbal intent, we will need to document via email to protect both the borrower and Amerifirst. Send borrower intent email from LOS for borrower to verify and confirm. Send borrower email with intent language and ask that they reply to email to verify and confirm. If you receive intent outside of the Encompass or Arise process, please send borrower's intent to your processor and they will update the LOS to register the LE intent. Now we will move to the other disclosure created by TRID, the CD or closing disclosure. The closing disclosure replaces the final till and HUD-1 settlement statement in the transaction. Please note the following critical points regarding the CD. Once the CD has been provided to the borrower, an LE cannot be reissued. The CD cannot be delivered on the same day as the most recent LE. It must be no earlier than the following day. A change of circumstance on a CD will not reset your baseline fee thresholds for calculation of tolerances and lender cures. Rate lock extensions cannot be documented via the CD. Amerifirst will instead document the extension of a rate lock and alert the borrower using memorandum style notice. Once the mandatory 3 specific day review of CD has passed, borrower will not receive another CD unless one or more of the following 3 scenarios occurs. The APR increases by 1/8 or more on fixed-rate transactions or 1/4 or more on adjustable rate loans. The loan amortization changes. Examples of this would include a fixed rate to an adjustable rate or a 5/1 ARM to a 7/1 ARM. A prepayment penalty is added. Please note that Amerifirst does not currently offer any products that have a prepayment feature. Closing disclosure timing specific to purchase transactions. The correct timing of the CD is critical to meeting your closing date. On a purchase transaction, the borrower must receive the CD 4 specific days prior to the closing date. Holidays and Sundays do not count towards the 4-day requirement. Please reference the calendar provided on this slide to familiarize yourself with this best case example. In this example, a CD was provided to and documented receipt by the borrower on Friday, October 23rd. The earliest possible closing date would be Tuesday, October 27th. This assumes that there were no reset events. You need only to establish receipt of the CD by one borrower on the transaction for timeline purposes. Now we will discuss the closing disclosure timing specific to refinance transactions. Unlike a purchase transaction, the number of days that a borrower must be in receipt of their CD on a refinance increases to 8 specific days. Using the calendar example on the slide, you will see that the earliest possible closing date using an October 22nd CD receipt would be October 30th. This again assumes there are no reset events. Again, this example illustrates the earliest closing date assuming all borrowers acknowledge receipt of the CD the same day as delivered. Later, in slides 7.1 through 7.6, we will review the effect on closing with various CD receipt dates. Please be aware that refinance transactions that include a right of rescission have specific rules if electronic disclosures are not employed. These rules regarding delivery of the CD are: the CD must be received by all borrowers on the transaction to establish loan receipt and therefore the earliest closing date. The CD will be provided to each borrower at their individual address. The Amerifirst method of delivery will be standard first-class U.S. Postal Service. The loan officer may, in limited circumstances, request an expedited delivery. Please note that overnight delivery will not document borrower receipt. The rules defining CR receipt and the mailbox rule are: the mailbox rule will always apply unless all borrowers wet sign and date their CD to document receipt. The signed and dated CDs are uploaded to the e-folder. Amerifirst will then review the disclosures to determine the borrower sign dates. The last signed CD date will be used to document CD receipt and to calculate the earliest closing date. Please note that it is advantageous to use the e-disclosure process whenever possible to shorten the earliest closing time frame. However, if the CD is sent via regular U.S. mail, the loan closing must be scheduled based on the mailbox rule. Each loan officer must be proactive in alerting the borrower to sign and date the CD when they receive it. The CD and the request timing of this document. A CD will never be provided automatically to the borrower. However, Amerifirst will automatically generate the CD request email using one of 3 methods: timing, status, or manual request. These are defined as below. The timing method is based on the target date, which is the earlier of the estimated close of escrow or the rate lock expiration. For purchase loans, the current date will be 8 days or less from the target date. Refinances will increase to 11 days or less from the target date. This method will be the Amerifirst default and no action is necessary to select this option. This method does not consider loan stage. The status method occurs when a loan officer requests the CD request to be generated at underwriting CTC. In order for this method to be used, the following must apply. The underwriter has assigned clear to close status to the file. The loan has not been triggered by the timing method. This method is selected related to the doc order when submitting the file to underwriting. Note that the underwriting CTC CD request option will not affect the above timing method. That is, if the CD at underwriting CTC method is selected, but the 8 or 11 day timing method is triggered, a CD request will follow the timing rule. The final method of CD request timing is manual. Under this method, the following must apply. The loan officer has manually requested to start the CD request process. The loan has achieved underwriting clear to close. Status method was not selected. The timing method was not triggered. The manual method can be selected via Encompass or through Manage the RED, located within ARC. This slide discusses the closing disclosure prior to underwriting clear to close. When the CD request is triggered at 8 or 11 days and the loan does not have underwriting cleared to close, there is a much greater risk of changes that can impact loan fees. Remember, once the CD is issued, there is no opportunity to increase borrower fees for tolerances, which mean fee changes are Amerifirst's responsibility. Because of this increased risk, Amerifirst has implemented some safeguards when generating the CD prior to underwriting CTC. There are 3 buckets for CD approvals. Green bucket. If the loan is underwriting cleared to close, the loan officer can request the CD without any other reviews required. Yellow bucket. If the loan has been submitted to underwriting but is not yet cleared to close, both the loan officer and branch manager must approve prior to CD being generated. Red bucket. If the loan has not yet been submitted to underwriting, then the loan officer, branch manager, and finally the regional manager must approve the CD prior to being generated. Again, the goal here is to make sure loans are funded on time and without fee tolerance costs to Amerifirst. This slide reviews the process from CD request to the CD delivery to borrowers. If you do not enjoy flowcharts, that is okay. The main purpose is that you understand the steps and process to generate a CD. The CD request email is triggered. The LO, LOA, and processor receive the CD request email. This email requires the loan officer to approve the CD terms. If the CD terms are not accurate, the loan officer will deny the CD terms and enter notes as to what is inaccurate. The loan is then edited and the CD request is resent to the loan officer for approval. If the CD terms are accurate, the loan officer will approve the terms and the CD request is sent to the CD preparation department. The CD preparer will work with title to confirm and prepare the actual CD document. Once the CD is prepared, the CD preparer will then forward to the CD auditor. The CD auditor will review the CD and work with the CD preparer with any issues. Once the CD auditor has approved the CD will be sent via e-disclosure to the borrowers. The LO, LOA, and LP are notified when the CD is sent to the borrower. This frame covers the procedure and content of the CD approval email that is sent to the loan officer, loan processor, and loan officer assistant. This email is sent when the CD request is triggered, and it contains pertinent information relevant to the transaction, such as purchase price, loan amount, fees, credit, and lock expiration. This email must be approved or denied promptly. Failure to reply will result in the system resending the email hourly until a response is received. Tracking is located within the Manage the RID by target date. Target date is the earlier of the estimated close of escrow or rate lock expiration. Now we move on to the process of verifying loan information with the buyer's agent. Once the loan is moved to Ready for QC, the buyer's agent will be emailed with limited loan information to confirm or correct. The loan officer, loan assistant, and processor are copied on the email. The buyer's agent is asked to reply all with response. The email that is sent to the buyer agent is informational, professional, and not intended to look like marketing. The actual CD is not included, just the following information: purchase price, close of escrow, last contract addendum number, seller credits, and agent credits. Additionally, the agent is asked to please inform Amerifirst of any of these changes in the future. Please discuss this process with the agent early in the process so they will be expecting this email and they understand how critical the information is to an on-time closing. This slide compares the differences in cash to close on the 1003 details of transaction and the LE. In short, the cash to close may not match. This example shows that the cash to close reflected on the loan estimate is $9,813, while cash to close on the 1003 shows the number to be $11,312.45. The difference between the two numbers is a total of $1,499.45. Continuing the cash to close example, this difference is due to the fact that the LE includes gift funds and the 1003 details of transaction does not. Additionally, the LE will round up to the nearest dollar. In this example, you see that the gift funds are $1,500 and the rounding total is 55 cents. These two items account for the $1,499.45 differential and how the two forms reflect cost to close. Yes, this is confusing. It will be necessary for you as a loan officer to explain to your client the differences between the documents so they can gain a clear understanding of the documents being provided. Obviously, it is desirable to reconcile the 1003 details of transaction to the LE cash to close for the purpose of clarity. The document shown is the understanding your numbers, and this slide includes an explanation of the difference and restates the total amount of cash to close. Please note that if the cash to close matches on the 1003 details and LE, this explanation text will not be included. This slide is an example of the rate lock extension notice that will be provided to the borrowers that was referenced in slide 4.0. This is a notice to the borrower and for file documentation. The borrower does not need to sign and no additional steps are required. At this point, we shift to the post-funding. TRID requires that lenders audit the final CD within 30 days of closing. The outcomes of this audit are clerical changes. This means the CD has some error that does not affect the numbers related to the amount the borrower must pay at closing or over the life of the loan. Examples are zip code was wrong, spelling error, etc. For clerical changes, AFI will mail the borrower a corrected CD. Financial changes. This means the CD has some tolerance violation that was not cured at closing and affects the amount the borrower must pay. For financial changes, AFI will mail the borrower a corrected CD and a check for the cure tolerance. No changes. Loan had no clerical or financial corrects. If no changes, no CD or communication will be sent to borrower. Note: the LO will be notified of CD changes prior to being sent to the borrower. As you can see from the various closing timelines and fee tolerance risks, it is very important that loans move through the process in the right timeframes to avoid rushing to closing. If the CD is sent prior to underwriting clear to close, you may have a fee tolerance error in costs paid by lender. If the CD is delayed until underwriting clear to close, you may miss a close of escrow. The good news is that if you have or develop a system for managing your pipeline, then the above fee and closing risks are greatly reduced. The next few slides look at the Manage the Red system in ARC. The goal of Manage the Red is to backstop to pipeline management where any yellow or red loan is in danger of falling behind schedule. Simply put, if a loan is not green, then it needs some attention. If you have not seen or used Manage the Red, please reach out to your branch manager. This is a great tool. In Manage the Red, all active loans with a RESPA application date are shown. Loans that have funded, were adverse or otherwise not active, are removed. Just a few things about Manage the Red. You can export your pipeline to PDF, print and use for your pipeline meetings. You can filter and sort by error code. Error codes are like locking expiring, loan behind schedule, CD needs to be sent, etc. All the critical loan progress events. This is an example of the concise Manage the Red print report. It shows the critical loan information and space for notes. This is an example of the expanded Manage the Red print report. It shows the critical loan information and space for notes. Information is the same on both reports, just the format is different. Use the one that works best for you. This is just an example of a loan officer Manage the Red view. Exact same as the branch manager view, except critical events are triggered one day ahead of the branch manager. As long as your Manage the Red loans are green and yellow, you will not show up with problem loans on the manager view. The next 3 slides are showing examples of the tool in Manage the TRID to help avoid problems. The main takeaway here is there are multiple people and departments reviewing your loans, and you may be contacted if and when a loan looks like it might be at risk. The next 6 slides are examples of CD and closing timing. Sometimes TRID timelines can seem a little abstract, so calendars with real dates and events can help. These are a great reference. In this example, this is purchase transaction with the close of escrow on October 27th. The last possible day for the CD to be delivered to the borrower is October 23rd. In order for this to work, everything must occur perfectly. The CD is sent e-disclosure on October 23rd, and the borrower acknowledges CD receipt in the same day. The borrower receipt starts the 3 specific day CD review period. The 23rd is review day 1. Saturday the 24th is review day 2. Sunday does not count. Monday the 26th is review day 3. Tuesday the 27th is earliest closing date. In this example where everything worked perfectly, the close of escrow is met. In this example, all the same assumptions as the previous slide. It is a purchase transaction and close of escrow is October 27th. However, the borrower did not acknowledge receipt of the CD until Monday, October 26th. Based on the TRID CD review period, the earliest closing is October 29th, and we missed the close of escrow. There is not a method or option to close on the close of escrow October 27th. In this example, all the same assumptions as the previous slide. It is a purchase transaction and close of escrow is October 27th. However, the borrower did not acknowledge receipt of the CD, and the mailbox rule is used for CD receipt. Based on the TRID CD review period, the earliest closing is October 30th, and we missed the close of escrow. There is not a method or option to close on the close of escrow October 27th. Obviously, we do not control the borrowers, and ultimately missing a close of escrow is viewed as a failure of the lender and loan officer. This is why the CD request process is started 8 days prior to close of escrow to allow for unforeseen problems and miscommunications. The next 3 slides are examples of a refinance with rescission loan in the same format as the purchase example. The intention is to show the timeline events to get to closing. In this example, this is a refinance transaction with closing on October 30th. The last possible day for the CD to be delivered to the borrower is October 22nd. In order for all of this to work, everything must occur perfectly. Remember, with a refinance with rescission, all borrowers must acknowledge receipt of the CD to start the CD review period prior to the mailbox rule. The CD is sent e-disclosure on October 22nd, and borrowers acknowledge CD receipt the same day. The borrower receipt starts 3 specific day CD review period. The 22nd is review day 1. Friday, October 23rd, is review day 2. Saturday, the 24th, is review day 3. Sunday does not count. Monday, the 26th, is the first day to sign. Tuesday, the 27th, is rescission day 1. Wednesday, the 28th, is rescission day 2. Thursday, the 29th, is rescission day 3. Friday is the first day to disperse. In this example, where everything worked perfectly, the closing is met. In this example, all the same assumptions as the previous slide. It is a refinance transaction, and closing is October 30th. However, the borrower did not acknowledge receipt of the CD until Saturday, October 24th. Based on the TRID CD review period and rescission, the earliest closing is November 2nd, and we missed the closing. There is not a method or option to close on October 30th. In this example, all the same assumptions as the previous slide. It is a refinance transaction, and closing is October 30th. However, the borrower did not acknowledge receipt of the CD, and the mailbox rule is used for CD receipt. Based on the TRID CD review period and rescission, the earliest closing is November 3rd, and we missed our closing. There is not a method or option to close on the close of October 30th. Again, there are multiple parties involved in a transaction, and we do not control everyone. This is why the CD request process is started at 11 days prior to closing to allow for unforeseen problems and miscommunications. We have covered a lot of information, so it is a good time to recap how we are going to be successful at TRID. Pipeline management is critical. If we do not send the CD in time, the loan will not fund on time. Obtaining electronic consent creates a convenient method to expedite disclosure delivery and document borrower receipt. Fee accuracy is critical. The initial LE sets the fee foundation for the life of the loan. Limited change of circumstances may be permitted to LE to adjust fee tolerances. No fee baseline or tolerance changes are permitted with the CD. TRID really forces us to focus on both pipeline management and fees. If you try to solve the CD timing issue by issuing the CD early, you risk the loan terms changing and creating fee tolerance costs. If you try to eliminate the fee tolerance risk by delaying the CD, you risk missing your closing. The big shift with TRID is to move the urgency from the back end of the process to the upfront process. That means complete submittals to underwriting early in the process and use actual fees. TRID can be as easy as A, B, C. A for accuracy, B for borrower documentation, and C for communication. Questions? Please email TRID questions to trid@amerifirst.us. We will do our best to respond quickly. However, if you have an urgent issue, please see your branch manager.